a pretty volatile Globex session here in the gold and silver markets, and I'm trying to catch up to the market here. Let's just watch the market here for a little bit, as I believe what we're looking at potentially is a reversion unfolding from the lows made today. We want to watch the market action into these levels here, and see if we get some buy-in at these levels, as it is triggering a buy signal on a daily basis in gold. From the 1780 level, 1781, 1779, this whole area down here is a major harmonic area, offering a tremendous amount of support. And basically it identifies for me as a self-directed trader, which is what I'm sharing, teaching here my subscribers in the room, that when you see this relationship in price between the daily, the weekly, the monthly, and you see the action in the market pretty much reverting from these levels here. If we do get a signal activated at 1781, a close above 1781, we're going to be kicking in a couple of major harmonic signals, which include daily, weekly, and monthly. So let's watch the market here for a little bit. I'm trying to scan across the different trends in the market here. And let's take a look at the weekly trends here. Not updating as of yet. A lot of data is being computed here to the algorithm for bringing it up to date, but what we see here, obviously, as I said, for the day, is the market, by trading into this level, this area, to me, is telling me there is a very high probability that if we see this kind of action here, making a low 1772.60, potentially is the reversion confirmation here that we've been looking for. The prices are aligned, and now what we're waiting for is for the buying to come into this market at these levels here and begin to accumulate the supply that has been offered pretty much down here, or begin to cover the short positions of any short nature that took place here. Let's watch the market here for a little bit, for a few minutes. we've slowed down the selling pressure that we had early this morning, and so what I'm basically looking for, let me tell you, as a self-directed trader here, one of the things that obviously I'm dealing with right now, and I'm sure everybody that is looking for this market to get to where it should be in terms of the real value intrinsically, or the mean, which is at much higher prices than what we're looking at, is the fact that we have seen in the last 30 days probably a record level of short squeeze. Short squeeze seems to be the favorite phrase right now, particularly being used by Reddit, by Wall Street Bets. They continue to publish, short squeeze, and the market is down $3 from what they were looking to short squeeze the market in. And so the obviously frustrating part that a lot of people are asking themselves is, how come the price is not going? On the face of this squeeze of cash, you might say, of supply problems that we have, mints are beginning to shut down, premiums are beginning to go through the roof, and pretty much the only place that you can get physical if you want to take delivery is in the futures contract. And the commitment of traders report that currently indicates that on the other category, besides the commercials and the hedge funds, the other category, which is primarily retail, individual, institutions taking delivery, is at a record pace. It's at a record pace. So my question is, why is the price of the futures contract, which is the paper market, going down on the face of a major shortage potentially of supply? Now, according to the cash market, you try to go out there and get some physical silver or gold, you can get it at a tremendous premium. And you got to wait a long time. So the short side of the market, which is the commercials, under the heading of commercials, have increased their short exposure. And so there is a definitely recalibration here of players in the market here that seem to be indicating to me that there is something brewing. Something brewing. That we don't know yet, that I think the markets are beginning to identify. And we want to pay close attention to this, because First of all, it may be very well the possibility that there is a major shortage, and Reddit does know something. Obviously, if they take a look at the commitment of traders report on the short side, they're going to see that the commercial banks category are heavily leveraged against the futures contract. And sometimes you're looking at a 10-to-1 leverage than what the actual yearly production is. And so as we get the physical market tight in supplies, which is making it real difficult for the retail business to buy in small quantities, you might say, the premium increases and pushes the demand into the futures contract, which puts the pressure on the COMEX exchange to be able to deliver the silver that seems to be at a record demand. And so I think the market and the forces to be are preventing the price from literally exploding to the upside to adjust again to just economically. The market needs to adjust to this huge debt bubble that we have, to all the stimulus coming into the market, this free money that is not healthy for the US dollar. It doesn't support the US dollar intrinsic value purchasing power. It is putting the short side of the market at a tremendous risk of being short squeezed. So I think what we saw here, this anomaly basically, is the central banks putting pressure on the paper market, forcing the buy side or the longs on the paper market to get stopped out. The difference is that now you have people that are buying into the futures contract that are willing to commit to taking delivery on the full size value. So they are allocating, even though they're buying on margin, the full value of 100 ounces in the futures contract to be able to take delivery if they are called, or to be able to have the margin available so you won't get liquidated, which is really the only way that you want to maintain a futures contract, is if you have an idea of taking delivery and you allocate the 100% obviously cost of the contract, but you can you can use 10% of that on margin, and in order to be able to hold the contract, as long as you have the cash available to meet margin calls if they do require. If you cover for the full size of the contract, there's nothing to worry about. You just got to be patient with the volatility of the market, and you secure your price through the futures contract. So it is a vehicle that can be used for taking delivery. I'm going to update this here in a minute. Please bear with me. One of the comments that, again, I want to make to my traders and my subscribers, and if you've been following me here, is that the volatility of these markets are increasing tremendously. And so you want to make adjustments on your personal profile in your account accordingly. Don't overtrade, don't overload your position, particularly if it's on margin, which is one of the reasons why I choose to trade the derivatives of the market. I trade the futures contract daily, and I take my risk daily. I have my choice. I have a fixed dollar cost that I choose personally, which I suggest everybody to have a maximum dollar that you're willing to risk on the trade regardless. This volatility is expanding, and it's not for everybody. It's not for everybody, and certainly the best way that I find to manage this tremendous volatility is by the application of the VCPMI, the algorithm. Although it is not 100% guaranteed, there are things that happen in the market like the pandemic that are unpredictable, that you just don't know and you can't predict. And you got to deal with it, know, and be able to recalibrate and stay alive, because the markets will adjust and the opportunities will come. As they have now, even though we're talking about this tremendous economic crisis that we're dealing with right now, which requires this amount of stimulus that economically over the long term is really not positive for the US dollar, is something that we need to deal with in order to be able to come out of this situation. The thing that I see, and I'm sure most of you guys see this, is that the markets are really not making any sense. They're they're doing contrary to the fundamentals. We have anomalies all over the place. We have bubbles all over the place. The equity markets are certainly in a bubble territory. But the idea that the Feds are going to continue to print money, quantitative easing, stimulus, is giving the markets a backstop, assurance that if anything happens, the government is going to be there to pick up their junk bonds, their ETFs, their paper. And this is on the face of a world debt bubble that, we're getting close to $28 trillion. So I think as a trader, basically, what I'm looking for is a couple of things here, as this cannot sustain itself, and there's no government that really is, I think, bigger than the market. The government can never be the market. Then we're talking about a different form of government, isn't it? if the government owns the market and they control everything, they subsidize everything, that is not capitalism. So that's a different discussion. But if we're talking about basically the free market enterprise here, although we do have this anomaly, what anomalies do is create incredible opportunities for traders. If you're a self-directed trader, for example. And the anomaly that we're looking at right now is obviously the stock market is one that we could potentially be moving into the possibility of a correction if we failed up here. So far, we've made a high of 39.59, and so we're trading now at 39.07. Excuse me. And the question is, obviously, is this a short-term high? I'm not saying that the market is going to be a bear market by any means or stretch of the imagination. With all of this free money coming into the market is expanding on its stimulus. And so stimulus is fuel to this fire. It's fuel to this anomaly. And this is what is causing a lot of these anomalies here, particularly in situations, for example, that we saw here recently developing in the silver market with regards to Reddit. This is the kind of environment that it creates, basically, with this a tremendous amount of cash available, free money given by the government. Where else is it going to go? You can't go out and spend it in the economy. We've been in lockdown. Restaurants are closed or limited. So what do you do with that money? Obviously, the Reddit crowd, which is the small retailer, has found a way to get it into the market. And thanks to technology, it has leveled the playing field, where you can have such an impact, you might say, in the marketplace as a player, as opposed to as an individual, you might say, player. You really are insignificant in the overall scheme of the market. So what I'm recommending here to my traders and my viewers here, if you're coming in every day, I think we are approaching a fundamental shift that should occur in the paper market. Actually, the value of the futures contract here, that they have pretty much gotten the price in the futures so far away from the actual value of the cash market that it's creating another anomaly. What the short side of the market is anticipating is that if they can bring the price of the futures contract low enough that it will affect the actual price of the cash market, and they will be able to come in and pick up the physical market at a tremendous discount. Well, guess what? You can't get the physical. You can't. I just confirmed, if the availability is the same for 1,000 silver bars, and 1,000 silver bars is about a week out, 10-ounce gold bars are plus 70 and are 2 to 3 weeks out. And 1-ounce gold bars are same price, 7 to 10 days out. Wow. The premiums, that it really feels very much the same as it did back in March, when they got the market in the futures contract to come down to 1450, and it caught everybody by surprise. It caught everybody by surprise. And guess what? That I think everybody's aware of it, what happened then, because the market bottomed at 1450 and it rallied $600 matter of 30 days approximately, or a couple of months. And the same thing, I believe, is about to happen, where you get the cash market inverted to the paper market. And in March of last year, we saw an $80 premium. Right now, the 10-ounce gold bar is $70 over spot. One ounce, 1,000 ounce bar premium is $2 over spot. So this could build up. Again, this pressure of supply could build up, because the expectation of the logic, you might say, you're bringing the market down in the futures contract, is that people will sell their physical to the market. They will liquidate their position. But people are not doing that. In fact, they're increasing their buying position, and this is what's making the short side of the market really nervous, is that any corrections in the gold market are short-lived. And not only is it short-lived, but it's getting a lot more buying interest, strong money to hold these positions. And it's really building to be an interesting market, because if we do get that premium, again, inverted cash to the futures markets, we could see another run in the price of gold. And particularly if now this Reddit crowd has identified the short squeeze in the silver market, or the short position short 10 times the actual production annually, could be an interesting play, because the risk of the short positions, according to the Commitment of Traders report, is running in the 38 to 40 billion dollars of short positions. So I think the cash market tightness right now, and I believe, again, gold mining companies, what they will do is simply pull out of the physical market and will stop selling the physical market. Like Majestic Silver did. Because the value in the paper market does not reflect the cash market, the actual physical, the actual gold market. And this is where the manipulation occurs, is in the paper market, forcing the actual values in the paper market to levels that force players to liquidate if they don't have any intention of owning the gold, speculators, retail, and obviously, as I said, affecting the cash and physical market, and they come in and buy the physical, the actual physical. So putting the fundamental noise that I call aside for a minute, what as a self-directed trader I try to do here is to take a look at, first of all, where is the market in its own technicals, and in silver, obviously, you can see that the market came in right into this harmonic relationship, which is the weekly and the daily average price of 27.42, and we've been kind of rejecting that price, selling coming in as we anticipate. So what needs to happen here is that either the market is going to come down again, down below to 26.76, which is another 30 cents, and activate the harmonic daily level of 26.76, or the weekly, and it's perfectly aligned with the weekly at 26.76. So if there was a place where you would want to add to your position, you might say, on your core, on the long side, it would be 26.76. Right now, there are no day trades. The trend momentum is neutral to bearish with 26.76 activated. Unless it closes above 27.42, which will validate the uptrend momentum and activating the targets of 28.07, 27, the 27.95, 28.07, 27.89. So it's kind of in a limbo zone right now. As a day trader, it doesn't recommend to, there's no trades. But the core position obviously is pretty bullish here. And these are the numbers that I use to basically confirm or negate the extreme above the mean or the extreme below the mean. If we come down to 26.76, it's putting the market at the extreme below the mean, and it's giving really high probabilities that you're entering a high area, a high probability area where buyers will step up, and or the buyers have stepped up a lot higher than 26.76, and that's what the market is trying to define. And the close about 27.42 is what will confirm it. So it's a pretty clear plan. On the gold, we're getting this trading into this area here that again is indicating a real strong harmonic alignment, and what we need is for gold to get back above 1781, and that will basically activate the daily, the monthly, the weekly from these levels here. Personally, I think we're a day or two from something significant happening from these levels here. And I don't, I think the downside is, again, very defined here. The downside risk, you're looking at what, 64 is the B2 level. This whole area, I believe, is a tremendous, again, area to consider accumulating. And if you're short or short hedges, this would be the area to complete them and pretty much go net long on the market without any hedge at all. The probabilities are extremely high. If you measure the price of gold just as an economic indicator, the numbers are extremely high levels than what the values are right now. So I do believe that gold and silver are tremendously undervalued, and particularly more undervalued as the cash market is showing tightness, and pretty much the cash market begins to dry up. It's going to put more pressure, obviously, in the paper market to adjust to that cash tightness that we have and reflect in the price. So it's a big battle between the cash market and the futures market at this point. It's got very, very quiet. One of the comments that were made yesterday by one of my traders was that there is a lot of talk about the 10-year yield curve going up, and some of the psychology, the mentality is that that is one of the reasons why the gold market and the metals are coming down, is that yields are going up or interest rates are going up. And I want to point out to you that I believe that we're in a different relationship with regards to the price of gold and interest rates. And I think the environment that is very similar to is the 70s environment. And if you recall, in the 70s, obviously, a couple of things happened. In 71, they lifted the gold standard of the US dollar, and inflation went through the roof. Interest rates by 1980, 81 were at 14%. And the price of gold was at $800-900. The stock market was at $1,000. So in an environment where interest rates rise, the price of gold can rise with it on a different environment. And the environment that we're dealing with right now is that we're moving into a highly inflationary environment once again. And so what I believe we're going to see is, number one, the danger of interest rates rising, which is a real critical element in the monetary system, because interest rates cannot go up. They cannot afford to let interest rates go up on the face of this bubble of debt that we have. Think about this. For every 1% increase in interest rates, what would it be in terms of the interest payment on the loan on the debt of 28 or 30 trillion dollars? It's impossible to sustain it, particularly as the debt continues to increase. And so the yield curve, or the short end of the yield curve, obviously is beginning to anticipate this inflationary pressure, which is putting a risk on US bonds and the US dollar. And it's beginning to demand higher rates for taking the risk of buying US paper in US dollars. And they're making the model based upon, inflation being under 2%. When in reality, inflation is running more like 10% if you include the food sector and energy, which are, two of the main ingredients in the economy. And so if inflation is going to get out of hand, and we are going to see this time around price asset increases, particularly for the retail end of the market, particularly for Main Street, food, commodity prices, energy prices are going through the roof once again. And this is on the face of an economy that is under lockdown, that has experienced broken supply chains, that continues to demand that the stimulus is greater than smaller, so to speak, to alleviate what potentially could be a systemic risk that we're dealing with right now. And I think things are a bit too extremes. Bitcoin, is another anomaly. So we're getting inflation in certain assets. Obviously, certainly Bitcoin has inflated its value tremendously in anticipation of a weaker currency, a weaker dollar. The mentality is to use it as potentially a hedge, you might say, a safe haven, a store of value, which it's another argument I think that falls into a virtual argument basically, and that it's appropriate for this virtual economy that we seem to be moving into, but it's not for Main Street, not for the masses basically. And so there is a difference of opinion there in terms of classifying Bitcoin as a currency or as a monetary unit. It's a trading asset. It's a virtual trading asset, in my opinion. And so let's see what happens here as we move into regulation and other governments taking advantage of this tremendous demand for virtual currency and see what they do. My understanding is that the IMF already has ideas about, or the World Bank, I should say, has ideas about implementing SDRs as virtual currencies. They're already doing that. They've been doing that between the banks themselves. But I think that they realize the tremendous demand that we have right now for virtual currency, which is really, I think, a cry for, you might say, help or taking control, you might say, of one's destiny in terms of our future economy, the future value of the US dollar, and pretty much protecting, our assets in terms of the US dollar. As obviously the market is beginning to get a real strong sense that where we're moving is a level of high inflation. Obviously my concern is that the velocity that we get to inflation, is far greater than what the supplies availability would be to accommodate such velocity, such demand, let's say, as we go back into the economy. So there are things there that need to be resolved in itself. But from coming back here to the markets, 1775 is tremendously, you might say, I believe, the bottom or the extreme of the range that we're looking at. And we're looking at about $100 range in gold on the upside of 1880. I think we're looking at the bottom of the range. And we've been trading in this range pretty much for a few months. So the confirmation that the final bottom, you might say, or the acceleration has begun is a close above 1880. We're looking at 1775. Right underneath is just tremendous support, all the way down to about, I believe, about 1740, 50 in that area. 67, 10, 67, 70 was the low made in 2020. So I think we're looking at the bottom of the barrel, basically. And so for those that are long this market, all you need is some patience. The market will adjust with a vengeance, I believe. And, coming down here, particularly for the silver market, I really believe it's like putting the price like a pressure cooker. It's pushing the price to such an extreme that when it does unfold, when the reversion does unfold, we could literally see a $4 or $5 move in a matter of days in here. And so you got to prepare for that. I certainly wouldn't be shorting it. I think the surprise, again, the path of least resistance is to the upside. I think we have approached, as you can see, once again a major level of support, and we're trading. Yeah, we're trying to identify the demand in here, so it's really slow, no volume, hardly any volume. The one that once again is showing more resilience in leadership is in the silver market, and so I think we want to pay attention to the silver market and pay attention to how it reacts pretty much from these levels here on the face of all these other fundamentals here that we have. Putting them aside again, just taking into account the tightness of supply in the cash market, the announcement of SLV potentially that they're going to have some problems on their fund in getting silver is really I think preparing for the market. So one doesn't really know what the SLV is going to do or how it's going to react to this short squeeze here, if it is actually putting a lot of pressure on the fund. I'm sure we're going to be hearing a lot more about the issues that they have with getting the supply that they need to meet that demand. So one of the things here that is a conflicting fact is that the funds themselves, in other words, SLV itself, is one of the major short players in the paper market, in the futures markets, because what they do is when they sell shares of SLV, they have to cover their positions and they go into the futures markets to cover their position. And so they're a major player on the short side of the market. And so if we do have this squeeze and the demand is record demand for SLV shares, it's going to be very difficult for them to be able to accommodate the demand and be able to maintain the short hedges profitable, or at least balanced to the demand that seems to be coming into the market. Just to recap here, from a cyclical point of view, I'm looking for these levels to hold here for the time being. I think we are probably a couple of days away from what I believe could be a reversion from these levels here, and the test is the upper end of the target of 1880. If we do break out of 1880, I think the acceleration will begin, and we'll be looking at 2000 handled here pretty soon. So continue to be patient here. Continue to hold your core position, and I look forward to talking to you next time. Thank you again for the opportunity to share this with you. Once again, my friends, be well. Take care of yourself. Talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Folks, John Najarian here with